Are we live? I don't know. Let's
Content of this
find.
meeting is being sent to a third party. That's what I'm
Yep,
seeing.
that is what should be happening. Let's see if it's actually working. There we go. All right. Let's see.
And
Is
we are
this?
live.
We are live.
Yes.
There it is. Okay. Some technical difficulties, but we got it going. That was super weird. All right. Welcome, everybody. This is the $1 trillion Show. And that is the new name, the new goal, the new mission of what it is that we do here. So, um, in the past, we've called this office hours. We're still going to do Q&A, but that's not all we're going to be doing. So with me, as always, is Serena. We've got Fatma on the line as well. She's our admin extraordinaire. And I'm on a new camera here, so it keeps going out of focus. So if that bothers you, that bothers me too. So there it goes. Okay. So I think I'm going to switch back to my old camera, but not right this second. Um, so you'll see I'm in a new place. I don't have my Tax Sherpa background up, and that is because I just acquired a new business here locally here in Atlanta, and this is the new office that I have. And this is the first time I've been in an office since COVID. In March of 2020 is when we shut down the old office that I was in. So it's been a while. It's been 4.5 years since I've been in a place that was dedicated to work. Um, but we'll have more on that over time. Um, in fact, one of the things that I want to do is actually, do a mass invite to all the people from the business that we acquired. But we haven't gotten that done today because it's just all just happened yesterday. So it's a whole new thing. But welcome, everybody. Today is November 5th, 2024, and this is the $1 trillion Show. So this especially matters today because it is election day. Now, I have not looked at any of the polls or anything that have been coming out throughout the day. Serena, have you been looking?
No.
No. All right. Well, we'll dive in a little bit later to see how that's all going. For the time being, what I want to do is I want to share. Oh, I forgot to turn on the recording.
Oh, and I forgot to tell you.
Yeah, yep, yep. All right. Now we're recording. All right. And that'll be saved to the cloud, which is fantastic. All right. So let's share the $1 trillion Show. So this is the new focus, the $1 trillion Show. And that sounds provocative, and it kind of is. Um, but the goal here is to save Americans $1 trillion in taxes. So rough numbers, Americans spent about 4 trillion in taxes last year. We want to cut that by 25%. And, you know, if you just do the math, right? So if there's 4 trillion, well, let's do it here. Let's do calculator. Let's say 4 trillion, thousand, million, billion, trillion divided by about 150 million taxpayers. That equals $26,000 a piece. Now, obviously, that is not evenly distributed. Some people pay zero, some people pay a lot. But if we average it out and we could save people 26 grand, that'll be great. And that includes, all forms of tax at the federal level, anyway. That's income tax, that's Social Security tax, that's Medicare tax. So that is the goal, to save Americans $1 trillion. Now, here's the thing about tax savings is that money did not disappear, right? It's just, is the money going to be in the pockets of the government, or is it going to be in the pockets of the people who earn the money? And then they can take that $1 trillion and do whatever it is that they want with that. And in my opinion, there is no contest. The world is better served if that money is in the pockets of the people who, earn that money through whatever market activity that they engaged in. And so that's the mission. That is the overall mission. Now, how do we do that is obviously the next question. And we do that through scaling tax saving strategies through technology. So what we'll get into exactly what that means, but obviously we have our own clients. We have several hundred clients that we deal with on an ongoing basis. And, we can do a lot of good for those clients and we save our clients giant amounts of money. And we do that by employing, advanced tax strategies. So that's all great. But there's only so many hours in the day and we can't serve the whole country. So the way to magnify that is to scale through technology. And I am working on implementing those technology scaling tools so that people can start to do their own tax planning and start to work on their own um, their own situations. Because part of the thing about taxes is that everything is unique to your individual situation. So what's true for you is not necessarily true for somebody else. And your tax plan and your tax situation has to take all of that into account. I was just talking to a woman yesterday who managed to get an enormously expensive solar panel system on her house. And the salesperson said, "Oh, there's tax credits and blah blah blah," and sold her on that. And so she thought when she filed taxes that she's going to get a huge refund. Like, well, that only works if you actually owe tax in the first place, and she doesn't. So, not, I mean, there's a credit, but it doesn't translate into anything as far as money back or anything, because you don't have anything that you owe, so there's nothing to get back. Um, and understanding those kind of nuances really make a huge difference to people's individual situations. So you gotta know what you're doing, and you gotta know how different rules apply to your situation, and that's kind of the key to the whole thing. And with technology being where it is today, we can start to do this at scale that we could never do before. And it's super interesting how information technology has evolved over the years. Everybody thought that robots were going to replace everybody as far as like manual work and all this kind of stuff. That has happened a little bit, um, but way more. You know, computers and robots on your computer have replaced a lot of what high-end people were doing. That was knowledge work. So everybody got it wrong as far as what was going to happen. But is what it is. So we want to make these tools available to as many people as possible so that they can use these tools to fix their own situation and reduce their own tax liabilities and add to that goal of $1 trillion. Now, I'm willing to accept that we might not reach $1 trillion all in 1 year. So that is what it is. Last week I showed how to save $92 billion. If everybody in America followed suit. I don't think everybody saw the show, but it's but we're getting there. All right. So the Who, this is me. I owed the IRS over $1.3 million. That's how I got into this whole crazy tax world. And over the years, I have worked on over 50,000 tax returns and founded and am chief tax strategist here at Tax Sherpa. So, my mission on a personal level is to help all of our clients, keep that as much of that money as possible so that we can reach that $1 trillion goal. The what? So this is a segment that I want to add to the show. As each week, I want to kind of go over like a what. How do we actually do this? So this will be new tools, new updates, news, and that kind of thing. So here's a what. 2024 versus 2025 federal tax comparison. So this is a little calculator I built. This is just a very simple example of a tool that we can use in order to get an understanding of what it is that is going on. So uh, Serena, let's, without any names or anything, um, somebody who made a good amount of money this year, what would be that amount?
Hmm. I
Just
would
pick the last person you
say
talked to.
600,000.
600,000. Now that's obviously higher than most people, but it does certainly happen. So is that person single, married, filing joint, head of household, married, filing separate?
Mary filing jointly.
Okay. And then, so that's 2024. In 2025, what do you think this person will make?
About 1 million.
About 1 million?
Mhm.
Okay. So here's a simple calculator. In 2024, if you make 600,000 of gross income, you got a standard deduction of 29.2. Your taxable is 570,000. Your tax liability, this is federal only, is $140,000. If you made the same 600 in 2025 with the adjustments that were announced by the IRS last week or the week before, your taxes would go down by 1.38% to 138,593. But at the million, um, again, still married filing joint and all that kind of stuff, your tax liability jumps to 282. And so that's a 101% increase over the 2024 tax liability. So the income didn't double, but the tax did double, actually slightly more than double. And the reason for that is because, the higher income is in the higher bracket and the lower income has is, steps through the lower brackets. So, it's important to understand these things because if you looked at your last tax return, you said, "Oh, well, I made 100 or I made 600 and I got taxed at 140,000." Let's see what was it? 140, 536 divided by 600,000. So you could say, "Oh, overall, I'm paying 23.4%, which is, not great, but it's not horrendous." But then if we go to a million and we got 282,000, now we're up to 28%, right? Yeah, 28.2. So the overall average rate increased because there's more at a higher bracket that dragged the whole thing up. And so, it's important to understand these things. So now it's like, well, if I'm looking at $1 million and I'm looking at $282,000, well, what can I do? This this starts the conversation, in your head, where you start to think about, well, if I do this strategy or that strategy and that kind of thing. So this morning I had a call with someone, and she's in New York and is a high flying tech executive, and she doesn't make quite this much. I think this year she's going to make about 500,000. And we were talking about different tax strategies. We were talking about tax credits. We were talking about leveraged charitable giving and all those kinds of things. And I said, well, if you wanted, uh, you could, you know, if you wanted to max it out, you can do 60% charity, right? So if you're making $1 million, you could contribute 60% of that, or $600,000, towards charity, and that will reduce your tax load. So like, how much will it reduce, right? So we were at 282,961. Let's keep that number, 282,961. And if we drop the income by 600,000, this becomes 400,000, and now we're down to 74,493. So that's $208,000 worth of tax savings. And so immediately, that sounds good, right? But then the question is like, well, there's fees and all this kind of stuff. How much am I willing to pay in order to save $208,000? And well, that's subjective, right? Some people want like a minimum return on their money. Some people are more flexible. Some people will pay $208,468 to somebody in the private sector in order to not pay $208,468 to the feds. So, you
Mhm.
know, it all depends on your priorities. Um, but by and large, um, you know, when we talk about like exotic strategies like that, they have a cost load associated with them, and they all kind of end up in the same net sort of basis. You're going to be paying 65, 70 cents on the dollar, somewhere in there. And so you might be paying, let's just say 65 cents. You might be paying 135,000 for that $208,000 savings. And it's like, well, do you want to make that spread? Is that worth it to you still? And some people, yes, some people no. Some people say, I would like to, but I don't have the cash, so let's do something smaller. But we start to have these conversations, and this is all just from a very simple calculator that I was able to build with the help of AI, by the way. I can't do the program myself, but I can tell the computer what I want and give it the brackets and all that kind of stuff, and then it spits out the code, and I test it and everything. So yeah, simple technology that we can start to allow people to access. And so this is a tool that will be put in the Explorers group and the Navigators group. The Explorers group is our free group that anybody can join. Navigators is premium group where we do a lot more. They get a lot more. But start with the free stuff. There's plenty there that you can have access to. Um, so this is an example of like the what and how we're going to get that $1 trillion back from the government over time. Um, Now, another what is today there's an election going on. So like I said, I have not followed up on the news. I don't know what's going on. Let's see what what's going on. Results. Let's see what we got here.
Let's see.
CNBC. I like 270 to win. I like their little map thing. Okay. Um, so they're still. I don't know if
A
this
lot
is
of red
updated.
states.
Well, yeah, yeah. I mean, the state-wise, it's always mostly Republican because, there's more rural area than urban area.
Mhm.
That's typically the split, rural versus. Let's see, live results. Oh, live results is none. How about forecast? Oh, no, that's okay. I see what's going on there. All right, let's see. Let's see what CNBC says. NBC exit poll shows democracy is voters' top issue, trumping economy. That's skeptical, but do we know anything yet? So it's still early. I think polls are still open in the East Coast.
So right now, from what I'm seeing, if you type in who is winning the votes for president 2024,
Uh-huh.
it says that Trump has 50,397 votes. He's at 67.6%. And then Harris is 23,185 votes at 31.1%.
Well, that's got to be some local place. That's not very many votes.
Yeah.
Uh, da, da, da. Let's see, Daily Mail. Okay. Looks like Trump is going to carry Indiana and Kentucky. I guess that's so overwhelming that they are already calling it for that.
Yeah. And it looks like a lot of votes are not going to kick in to like Texas is at the results will be expected around 7 p.m. Central.
Uh-huh. Yeah, so it'll be a couple
Um,
hours after we finish up.
yeah.
But yeah, one thing that's interesting, by the way, is foreign media is usually more objective, and this is true for all foreign media. So you know, like BBC is good for looking at American, but they're terrible at looking for British stuff because there's all this, all the bias built in to their home reporting. And so, Russia Today, which has been vilified over the last years, they're in my experience anyway, they're a good outsider perspective, but of course they're terrible on Russian news because they're an agent of the of the Russian state. So getting those outside perspectives is often pretty helpful. So American news is good looking at other stuff, but not so good at looking at American stuff, at least in my opinion. Um, so that pattern just repeats all across the world. So if you want objective things, look for news sources outside your home country. Um,
So, question for you, Neil.
yeah,
What do you think about a liberal president?
a liberal president. You mean like if Kamala wins?
Yeah, kind of.
Yeah,
Yeah.
yeah. Well, it's you know for as far as taxes go, um, you know, Kamala is in favor of much higher taxes, and Trump is in favor of somewhat lower taxes. Either way, though, both whoever wins will have to get the cooperation of Congress in order to pass bills when it comes to taxes. So it's not a vacuum. There is no scenario where when Trump came in 2016, he had super majorities in Congress and they had the presidency for the Republicans. So they were able to get the Tax Cut and Jobs Act passed because they didn't need any Democrats to sign on. But that is not going to be the case this time. So and the reverse is true too. Even if Kamala wins, she's not going to have a strong majority in Congress for Democrats. So they're gonna be limited in terms of what it is that they can get passed to whatever deals they can reach. So for tax policy, it's we'll kind of have to see how the negotiations go. Um, but as far as like direction of the country and all that kind of stuff, personally, I think more freedom is better and more government control is worse. So, you know, uh, given the candidates that we have today, that would make me not favor Kamala.
I
Um,
agree.
all right. So that's some of the what. And each week, what I want to do is I want to feature um, either a new tool or an update or something that we can start to chip away at the $1 trillion, and hopefully people will be able to use those. So, and we'll come back to the calculator towards the end here. So on to the questions. So people always have questions, and I have the answer to every tax question. The answer is it depends.
It depends.
And it depends. So, like I was saying earlier, facts and circumstances. What is true for you is not necessarily true for somebody else. Um, how you earn your money, how you spend your money, what your family situation is, what kind of assets you have, what sort of business entities that you may or may not have. All of these things affect taxes. So, like the woman I spoke to yesterday, she bought these solar panels. She paid an ungodly amount of money, and um, there is a tax credit associated with solar panels. You get 30%. And but it's non-refundable, and it carries forward. So non-refundable means that it only pays to the extent that you have tax liability. So if you make no money, let's just say, make $0, your taxes, your tax liability is zero. And so if your tax liability is zero, no matter how many non-refundable credits you have, you will never get any money back out of that. If they were refundable credits, then you would. So, like the earned income credit for children is a refundable credit that will pay you even if you don't owe anything. Non-refundable credits only reduce liability, and that may create a refund depending on what your overall situation is with your withholding. And that is not the first time I've seen somebody fall into that trap with the solar panels. And what happens is that there are these sales guys who say, "Oh, there's a 30% tax credit. So you spend $50,000, it's not really 50,000 because you're only spending you're going to get 30% back on your taxes." It's like you can't listen to salespeople when they're trying to give tax advice. It's a terrible way to go because it depends on your particular facts, your particular circumstances. Now, if you owed 100 grand in taxes, you had $100,000 tax liability, and you get a $50,000 tax credit that's non-refundable, then yeah, you get 50,000, sure. But that is not everybody's case. Um, so without further ado, let's get into some it depends, Serena. What do we have as far as questions go?
Alrighty. So we have a client. We're going to
Uh-huh.
call her Sarah.
Uh-huh.
Not a real name,
Yep.
but Sarah is 28 years old, marketing specialist who recently got promoted. She started to
Okay.
think about her long-term financial health and has some questions about her 401k and
Uh-huh.
tax-efficient savings. So
Okay.
her question to you, Neal, is I just got a raise. Should I increase my 401k contribution to reduce my taxable income? And are there any other retirement accounts I should consider?
Yeah, so I mean, should you is up to you, right?
Right.
So retirement accounts just across the board, they are you take money away from the current year, you put them in the special account, and there's different flavors. And depending on what type of account, you might get a benefit in the current year. So the most common one is the traditional 401k. So 401k, it's called that because that's the code section that it comes under. Um, 403b, 457s, these are all different varieties of the same kind of thing. And those numbers come from the code sections. So, um, so in 2024, you can contribute, I believe it's 23,500 as your employee contribution maximum. So let's say you earn $100,000 of W-2 income, you put in 23, let's just say 23,000. The math is easier. You put 23,000 into a 401k as an employee. Maybe your employer matches, maybe it doesn't, but that's on their side. And that money goes into a 401k account, and you get a tax deduction now. So instead of paying taxes on 100, you pay tax on 73, which is that 100 minus, I'm sorry, 77, 100 minus the 23. Okay, so the money that you save in the current year is the marginal tax on that $23,000 that you put into the 401k. Now, important to remember that even though you get a break on the income tax, you do not get a break on the Social Security and Medicare on the full 100, even though you put the 23 into the 401k. And the reason for that is because of the deal that you're making on the back end. So you get the tax break today, you put the money in the account, it grows, it grows, it grows, hopefully, right? You make good investment decisions. And then in retirement, you tap that money. And when it comes out, you pay the income tax on that part, but you do not pay Social Security and Medicare tax on it. Okay. So when you look at the total lifetime of the money flows, is that you're paying tax on everything for both income tax and then payroll taxes, which is the Social Security and Medicare. But you're splitting up the timing of things. And so you have to what am I trying to say? You have to do the speculation as far as like what are my investments going to yield? What is inflation going to do? What are tax rates going to be in the future? And given all that, do I think this is a good deal? Some people say yes, some people say no. So, should you do it in order to lower your tax liability? It's certainly an option, but you got to make those subjective decisions for yourself. Um, but we can certainly guide you through the math on how it's going to work. As far as retirement account types, there are multiple types. So the first distinction is traditional versus Roth. So traditional, you get the tax break today because you're locking this money up, and then you pay the tax on the back end when you withdraw the money. Roth is you do not get a tax break today, so it wouldn't help at all in terms of your current year taxes. But the upside is that when you take the money out in retirement, you don't pay any taxes then. So, a lot of people think that that's going to be a better long-term strategy as opposed to the traditional. But, it's very subjective and your um, sensitive to your assumptions, right? So what do you think tax rates are going to be in the future? What do you think inflation is going to be? Because all of those are going to affect the real discount rate that you have to apply to that future income. And so if I get tax savings today, what am I doing with that tax savings? Am I just, you know, going out to eat, or am I investing that tax savings and creating even more funds into the future? So all of this makes enormous differences in those long-term projections. Um, and so, you have to be mindful of the assumptions that you're baking into that scenario. So we got traditional, we got Roth. As far as flavors of accounts, for employee employer accounts, you got 401ks, 457s, 403bs. You're going to be limited basically depending on the type of employer that you have and what they have on offer. So whatever they have, right? On the individual side, you also have IRAs, um, where you can put up to, about $7,000. And the there are potential income limits when you talk about IRAs, as far as whether you are eligible or not. Um, there's also strategies like a backdoor Roth, where you contribute to a 401k and then you roll it over into an IRA, and then you convert it to a Roth because you make too much money in order to be eligible to contribute to a Roth IRA. Um, then there's non-tax retirement strategies. There's things like the infinite banking concept, where you use life insurance as a savings vehicle in order to build up cash value. Um, you could always do. I talked to some guys at FinCon um, last week or week before last, and there was a mortgage shredder uh, platform. And what they do is they use home equity lines of credit in order to pay down mortgages and save on interest costs over the lifetime of a loan. And there's a whole strategy to it. But basically, if you are able to aggressively pay down your mortgage, you short circuit the interest cost of that mortgage over the 30 years that you might have been paying it otherwise. And if you can pay that off in 5 years, 7 years, something like that, then you can save yourself hundreds of thousands of dollars in interest cost over that lifetime. And then the question becomes is like, well, does that make for a better retirement to free up cash flow in order to do that, so that you can then invest, even if it's not in a retirement account, um, in order to build a value, build your wealth, because people get too hung up on the particular mechanism, I think, in at least in my opinion, because it's like, oh, I want to max out this or I want to do that. It's like, okay, but overall, the goal is build more wealth faster, right? And there's different pros and cons to the different vehicles, but that's the overall goal, and you don't want to lose sight of that. So make sure that you're looking at your overall holistic, viewpoint rather than just focusing on one strategy or another. Um, and I know that was a lot of it depends, but yeah, so that's kind of the sorts of things you have to start looking at when it comes to those kind of questions.
I was gonna say, Neil, maybe our show should have been called "It Depends."
Yeah, yeah.
$1 trillion show.
I like Trillion Dollar Show better, but
Yeah.
we'll see.
So funny. So we have a question from a married couple with children,
Uh-huh.
right? They're in their 40s and they both work W-2 jobs.
Okay.
They want to know what tax credits or deductions they are eligible for as far as parents goes,
Uh-huh.
and can we claim the child tax credit or any other education credits?
Yeah. So there's three sort of four typical credits relating to children. Um, so the first one, like, whenever tax season rolls around, you'll see these signs on roadsides and things like that. It's like, $7,000, for two kids or something like that. What those signs are talking about is the earned income credit. So the earned income credit is for people who have children, primarily, and who have earned income, meaning like day job type income, and they don't earn enough according to the government. And so the earned income credit will pay them. This is a refundable credit, meaning that even if they don't owe any taxes, they will still get a refund from the government because it's a subsidy that the government gives towards people in this situation. And it's the biggest child tax credit. Um, so that's the one that gets advertised and pushed the most. And if it applies to your situation, then great. You can get a lot of money out of it. Um, the second credit that applies to most people with children, and if you're a super high earner, it starts to phase out, but is the child tax credit. And so the child tax credit is the one that's been monkeyed around with the most over the last, well, since COVID, basically. So it used to be $1,000, and it was like part refundable, part non-refundable. Then during COVID, they raised it uh, did it get as high as 3,000? Yeah, it got up to 3,000. And then it depended on if the kid was under or over the age of 6, and it was fully refundable. And so currently, we're at $2,000 per child, and it is partially refundable. I think 1,400 is refundable and 600 is non-refundable. So you'll get some of it if you don't owe any tax liability, but if you do owe tax liability, then you should get all of it. And so that's the second most common one, or the second most popular one, I guess, because the amount is less than the earned income credit. The third tax credit relating to children is for children 12 and under, and that's the child care credit or dependent care credit, and that has to do with daycare, aftercare, camps, that sort of stuff. That one's a little tricky sometimes because if there's a married filing joint couple, both parents need to have earned income in order to claim that credit. So if one stays at home, even if they pay the money, it still doesn't count for that particular credit. That one is worth, depending on your income, can be worth, $800 sometimes, but usually more like 600 per child. Um, and then when it comes to education, so education credits start to kick in at college. So if you just mean private school, then no, but there is a strategy for that. Um, so as far as credits go, there's two basic types. There's the good one and the not so good one. So the good one is the American Opportunity Credit. So the American Opportunity Credit is for 4-year bachelor or associates, 2-year associates or 4-year bachelor degrees. You can claim it up to 4 times, and it's worth up to $2,500, and that's for credit for money paid out of pocket for tuition and books and fees and things like that. The not as good credit is the lifetime learning credit. And that's going to apply either after you've hit your 4 years of American Opportunity Credit for undergrad, or if you go to graduate school. So if you go to take a master's or you go to law school or any of those kind of things, after you get your undergraduate degree, then the lifetime learning credit kicks in. Lifetime learning credit is not as good. Instead of 100% credit, it's a 20% credit. and there's income limits and all this kind of stuff. So it's not as powerful. Um, so then, I had mentioned that there are strategies for dealing with things like private school. So private school is not deductible. It's not, it's just an expense you choose to take on. However, you have to look at it holistically, like I was just saying with the other case. So, do we care that a particular deduction is assigned to the private school? And the answer should be no, because as long as we get a deduction, then it's fine. So one of the ways to deal with this is to do a what we call the climber plan. So the climber plan is putting your kids on payroll, and you can also set them up with retirement plans like IRAs, because once they're on payroll, they have earned income, then they're eligible to contribute to IRAs. Um, so basically, if you have a job for your child between the age of 8 and 17, and there's all kinds of caveats that go into this, um, then you can pay them for that job. So I have my new office here. I'm going to be having my 10-year-old come in and scan all this mail that's on my desk because I hate paper and I want everything scanned. So, there's actually an hourly rate based on my location, my business type, and all this kind of stuff for people that do office admin type of work. And my 10-year-old will be doing that, and will be filling out timesheets, and be paid an associated wage that is commensurate with the work that is done. So, and so once that's completed and the payroll is done, now there's a bank account with money in it. And the question is, what do you do with that money? The answer is whatever you do with other money, right? So if you're paying for private school, then you just use that money, right? But that becomes a deduction because it is a payroll expense for work that is actually done. And the fact the fact that after that it goes to pay private schools is immaterial. So that's a way to mentally deduct private school, even though directly that's not what you're doing. But so you'll always want to keep an eye on the overall picture and understanding that, so that you don't get caught up on calling something one thing or another. And I know that's a recurring theme that I've been saying, but it bears repeating because we just see it too many times where people get too hung up on one detail or another. It's like, again, the overall goal was we want to grab $1 trillion back from the government, and we want everybody listening to be part of that. So yeah, those are the different things related to kids, and all of them have income ranges that are associated with them. Some of them will phase out. Some of them have the requirements, like with the child care credit. Both parents have to have earned income. You can't just have one. Things like that. So there's caveats with everything as far as all the details. But yeah, that's kind of the basic rundown.
All righty. So we have a question from a small business owner. His name is Mike. Big name, guys.
Uh-huh.
He runs a small landscaping business, and
Okay.
he's really trying to maximize on his business deductions.
Yep.
And he's also considering hiring additional employees. He
Okay.
wants to know what is better to hire when it comes to taxes, employees or independent contractors from a tax perspective.
Uh, the first thing comes to mind is it depends. So when it comes to hiring for tax purposes, so bottom line is that your expense in employing somebody, whether they're an employee or whether they're a contractor, it's a deduction. Okay, so let's say before we have any employees, I've got $100,000 of net income. So I sell my if it's landscaping, you know, I'll have, I don't know, $200,000 worth of revenue. I'll have $100,000 worth of expenses for supplies and machinery and all this kind of stuff, repairs. Man, the landscaping guys, the repairs on their equipment is just crazy. It's just constant.
Mhm.
Um, so okay, so bring in 200. I spend 100 on other stuff, and now I've got 100 left with which I can pay somebody or pay people, right? So if I pay a contractor 20 grand, or if I pay an employee 20 grand, including all the various things for an employee, then I still have a $20,000 deduction either way. Okay. So tax-wise, from that perspective, doesn't make much of a difference. Where it does matter, and matters a lot, is with the qualified business income deduction. So part of the Tax Cut and Jobs Act was this creation of this concept, the qualified business income. So this is on pass-through income, which the vast majority of businesses are. You get a deduction based on a couple different things. Factor number one is the net profit. Factor number two is the assets in the business. So, like if it owns real estate or something like that. Factor number three is the payroll, and that means W-2 payroll that the company pays out to all employees. Could include yourself, could also include third party, other just direct employees. So, if you are in a situation where that matters, and there's different thresholds for when that starts to matter depending on your filing status, then it can make a huge difference as far as what your ending tax picture is if you go employee versus contractor. So, you wanna math that out and figure out, what situation am I in? Does it matter to me for my situation for qualified business income deduction purposes, whether it's employee or contractor? If yes, that would tilt heavily towards employee. If no, then contractor is simpler to administer because there's just less regulatory requirements. However, then there's a whole other set of criteria. Is like, well, there's a term I'm forgetting, classification. So if when they go through a classification exercise that they should be an employee, then it doesn't matter what the tax situation is. They should be an employee, and that has to do with the degree of control you have over this person's activity. And there's a whole series of factors as far as the decisions or as far as the classification for whether they should be a contractor or whether they should be an employee. But sometimes it makes sense to bring somebody who is a bona fide contractor on as an employee, even if it's part time, in order to boost your own tax deductions. And yeah, so it just depends. All right,
It
let's
just
do.
depends.
It just depends. Let's do one more, and then we'll wrap it up.
Okay. So we have a retiree with multiple income sources.
Uh-huh.
So we have a client. Her name is Linda, supposedly
Uh-huh.
67-year-old retired teacher. She receives pension, Social Security benefits, and investment income.
Okay.
And she wants to ensure she doesn't pay unnecessary taxes on her retirement income. Right.
Okay.
So she's asked, how will my Social Security benefits be taxed, and are there ways to minimize the taxes?
Um, yeah, so the first part is that Social Security gets taxed on a sliding scale. It's either going to be
Hmm.
anywhere from 0% taxed to 85% taxed. And the thing that determines the sliding scale is what the overall income is for the year from all sources. So the way to reduce tax on your Social Security benefit is to reduce your overall income. And there's different ways to do that. I mean, again, depends on the particular situation. Um, but it might be worth setting up, a small consulting business and taking advantage of strategies there in order to lower the overall income so that your Social Security gets reduced as well. It depends on the thresholds, depends on the numbers and all this kind of stuff. So I've seen people getting $200,000 from when you add up the different sources. It's like, you're probably stuck paying that 85%. Um, not that you're paying 85% tax, but you're paying tax on 85% of the Social Security. So I remember I was looking at this when there was Trump was talking about doing away with making Social Security benefits taxable to people in retirement. And there was a whole thing where people would say, no, you're gonna kill Social Security even faster and all this kind of stuff. And there's about $50 billion worth of taxes that are paid each year by the recipients of Social Security on their Social Security benefits. And so if that were repealed entirely so that everybody's Social Security benefits were tax free, then yeah, you would be reducing revenue to Social Security by $50 billion. But in the end, it would shorten the lifetime of Social Security by about 6 months. So it's not a huge factor either way. Um, but yeah, so you have to look at the numbers and see where you fall on that sliding scale. And there's a worksheet to do that if you want to look up um, on the IRS website, you can look up the Social Security tax worksheet. I think if you search that term, it'll come up, and that's what the calculations that are done inside of any tax software does. To determine how much of that Social Security benefit is taxed. Because when you look at the 1040, you'll see a line for the total, and it'll be like a box in the middle of the page. And then over on the right-hand column, where there's all the actual numbers that are going to your tax return, there'll be a smaller number than what was in that middle column. And the question is just how much smaller is it going to be? Is it going to go all the way to zero? Is it going to be 85%? Somewhere in between? Just depends on the numbers. So the overall strategy, though, is to lower overall income, and that will have a double benefit by potentially lowering the tax on the social or the amount of Social Security that is taxable. If you want to, if you want to just cover your bases, though, you can do withholding on your Social Security. It's funny. I actually had a client do this one time where she called up Social Security because she was in a state where Social Security is partially taxed. So a lot of states will have different levels of exclusion for retirement benefits, and it could be Social Security, it could be pensions, could be whatever. Um, and so she called up Social Security to ask if they could withhold on the state level as well. And the person on the phone says, no, we don't do that because that would be, too complicated. Essentially, that was the bottom line. Because all there's 50 different states, they have 50 different sets of rules. It's like, yeah, you mean like every other company in America does? It's like, no, no, that's too much work. We'd have to actually, do our jobs or something. But yeah, that's fun times from Social Security Administration. But they will do federal withholding. So if you're concerned about it, you can tell them to withhold on that, and then you should be okay. Um, but yeah, there's lots of income reduction strategies. But again, that's a bit too general in the sense that we don't know what applies to that kind of situation.
Right. Right. So Neil, she also asks, she wanted to learn more about required minimum distributions,
Mhm.
RMDs.
Yep.
How does those work? How does that
Yeah.
process work?
So RMDs is so if you put money into a traditional plan, whether it's traditional IRA, traditional 401k, or whatever, and you got that tax break during your working years, then on the back end of your life, the IRS wants to make sure they get paid. Okay. So the RMDs start to enter, and the numbers have been tweaked recently from the Secure 2.0 Act, and it used to be 70 and a half. Now it's 72. So at age 72, they will force you to start withdrawing from your tax deferred plans. So your traditional 401k and whatnot. And how much they force you to do is based on a table. And they tweak these every so often. But basically, they'll kind of do uh, it's not really an actuarial calculation, but it's close to an actuarial calculation. So there's a table you can look it up about RMD distribution, percentages, and basically at 72, they're going to make you take out like 4%, and then 4% of the balance of the plan. So if there's $100,000 in the account, you got to take off 4 grand. And as you age up above 72, they'll force you to take out a larger and larger percentage of the balance because they want that thing to be liquidated because you got to pay taxes on that. And then if you pass away with that plan still having money in it, it's going to pass to your heir or heirs, and they're going to have to pay. They're going to have to start pulling it out over a 10-year span, and then by the end of the 10 years, it's got to be completely zeroed out. So the maximum lifetime of a 401k or an IRA is your lifetime plus 10 years. And at that point, it'll be fully defunded and all associated income taxes will be paid. So that's where the RMD comes from. Now, there's a little nuance to that in that so the plan administrators, whoever you have your plan with, they all do these calculations. And and usually they'll send you a letter. They'll say, okay, your RMD for 2025 is going to be X, $2,000, $5,000, whatever the number is, depending on your age and depending on the balance in the account. And then they'll just send it to you because they have to send it to you. The nuance is that the RMD is for all of your accounts combined. So you have to think about this. So if you have an account at Vanguard and you have an account at TIAA CREF and you have an account at Fidelity and the whole thing is, let's just say $100,000. And so you have to take 4 grand, you can pick and choose where you take that 4 grand from. So you might want to put the RMDs more towards one account versus another, and you have to inform the administrators of this so that they don't all send you RMDs. So there is a little bit of strategic work to be done there if you prefer to keep one account longer than another. If you do nothing, they'll all send you RMDs and the total will be the same, but then they'll just be drawn down proportionally. Um, but yeah, it's worth looking at because almost always there's one account that people like more than another. So if that's true for you, then look into that as far as where you want that money drawn from first. Does that make sense?
Yep, makes sense.
Awesome. All right. So we're coming up on the hour, and let's see if we got any new news here from the Daily Mail. And no. Okay. So we'll see. We'll see. First polls close at 6 p.m. Eastern time. And so we are past that. So things will start to come in here. I know here in Georgia, they're already trying, or they have been trying to prepare people. Said, hey, it might not all be done on election night, but hopefully we'll get some kind of answer sooner rather than later. I think having a drawn out process is definitely not what anybody wants. All right. So as we've shown, it depends. And so what's next? Next is become an explorer. And the Explorers is our free group. Like I said, totally free. You guys can join up there. You'll get notifications about streams like this and the all the tools that are being built. All of those free tools are going to be put in the Explorers group, along with there's other free courses and things like that we have developed. Um, and you'll have the opportunity to join the Navigators if you want to become one of our premium group members. And that's, I'm not going to get into all that there, but Navigators is a lot more and better. But you can go to taxsherpa.com/explorer, or you can scan the QR code there, and that'll take you to the sign up page. Totally free. And main thing is you will have access to um, all the new tools that are coming out. Some of the ones that have already been built that I'm a big fan of is probably my favorite one is the quick and dirty bookkeeping, where you can just upload a bank statement and it'll do categorization for you. And then you can take that and put it into a special sheet that I've already made for you, and it'll do a quick and dirty profit and loss statement for you on a monthly basis. So and it takes about 5 minutes a month if you have a simple bookkeeping situation. If you have a complicated situation, it's not going to do it for you. But if it's simple, which 95% of businesses are, because it's just cash in, cash out, there's no loans, there's no assets, and all those kinds of things, um, then it can do that job in 5 minutes a month, and it's totally free. So I recommend it strongly. And I that's a tool that I built out of my own frustrations because I was tired of people just sending me bank statements when what I need for tax purposes is profit and loss statements. So I was like, I'm sick of it. I've been doing this for years and years. I'm gonna build something, and I did. So I was able to make that work, and then I just made it available because the cost to me of doing that is $0. So it's built. You can use it using a free ChatGPT account. You can use it using a free Google Sheets or you know, a Gmail account. Basically, everybody who has Gmail also has Google Sheets, and then you just use those two tools together in the way that I show you inside the learning portal, and you can do all that on your own for free in 5 minutes a month. So definitely worth checking out just for that alone. But there's also other things in there. There's a book on partnerships that I wrote, which reminds me, I need to send that to a lawyer that I met, where you know people go into partnerships all the time, and almost all the time they don't plan out what happens at the end. So the the partnership thing is the 13 questions to go over before you sign that partnership agreement, so that when things end, because they all will end one way or another, then you have a plan in place to deal with that. Now, I would say like 11 out of those 13 are like bad situations that you don't want to be in. And if you get to that point, then you might not be on speaking terms with your partner, but two of them are just natural life occurrences. So you just want to make sure you have a plan in place so that you don't get stuck in a situation that you have no control over because you didn't build it into the front end. Just as a quick example, divorce. Divorce happens. I'm sure you've heard that statistic that half of all marriages end in divorce. That's not quite true because that does not account for the fact that there's a lot of people that are repeat offenders. So like if you get one divorce, you're like uh, twice as likely to get a second divorce versus somebody getting married the first time. But however that works out, right? So if your partner gets a divorce, then you might end up with a new third partner that you had never planned on. Or maybe, the partner that you liked end up losing in the divorce, and now that partner's gone, and now you're dealing with that person's ex. So all kinds of bad situations could happen. But if you plan for that up front and you have a mechanism in place, then you can just cut off the partnership before any of that materializes, and you don't get exposed to that negative situation. But you got to do the planning ahead of time. You can't do it when it happens. By that point, it's too late. That's like a lot of things in the tax and legal world. You gotta By the time something happens, it's already too late. We got to plan ahead of time, and that's what all these tools are about: is thinking ahead and planning ahead so that you can build the best value for yourself and keep as much of that $1 trillion as possible. So, with that, that has been the $1 trillion show for November 5th. We'll check in next week. Hopefully, we'll have a winner by next week, and we'll have some idea of what the next couple of years are going to look like from a tax perspective. And I'm sure that will be the topic next time. So, with that, we're signing off. Thanks everybody for hanging out, and we'll see you next week. Same time, same channel.
All righty. Bye.
Bye bye.
Bye.